while I do think the live commerce, video commerce, it's all influencer commerce, it's all here to stay. The question is, can you create an independent third front? If you're playing cricket, then you have to play by the rules of the game, right? You bowl a certain way, you bat a certain way. So if you are making early stage investment, that's a rule of the game that you will need to write off assets. In general, I think, founders do bring in something special to companies. So you can't take that away. But at the same time, there is obviously the same things that they bring to the table sometimes also become limiting, and there is value to professional leadership.
Following is a conversation with Rajul Garg, who is the founder and managing partner at Leo Capital. As part of Leo, as well as an angel previously, Rajul has made many active investments, and some of his successful investments include Meesho, HealthCart, PeopleStrong, etc. Previously, Rajul was also the founder of Pine Labs, which is now a unicorn. And after exiting from Pine Labs, he went on to found GlobalLogic and Sunstone Eduversity. In this conversation, we touch upon what should founders look for in investors before bringing them to the cap table? How should founders as well as investors look at evaluating PMF? How do you go to market in a crowded space where there might be many competitors, but you come up with a new approach? How do you come up with plans for user acquisition and user retention with a much higher return on investment or a much lower burn rate, and many more such topics on building a lasting, successful business? I found this conversation very unique and extremely insightful, with some unique perspectives around how should founders be choosy in getting investors onto their cap table, as well as knowing when and how to raise and from whom to raise funds. So stay on, listen to this conversation with Rajul Garg on the KVKurious Podcast. Hi, Rajul. Welcome to my show. Thanks a lot for taking time to chat with me. For the audience, Rajul is the founder of 4 companies: Pine Labs, GlobalLogic, Sunstone, and more recently, Leo Capital, having had 3 exits in the past. Thanks a lot for taking time to chat today. I'm really looking forward to this conversation.
Krishna, thank you for inviting me. Happy to be here. Always happy to share some of the experiences that I have gotten through. So thank you.
Sure. So Rajul, tell me something. Maybe I'd begin with this, right? Startups began to become mainstream in India maybe around 2007-8 when InMobi started, or Flipkart started, and maybe some of these became unicorns around late 2010s or early 2011s. But you seem to have started way earlier, back in 98, with Pine Labs and then Logic, and maybe also 2 exits. So what was going in your mind back then, and what really gave you that plunge to start up?
I think startups, I know the momentum picked up more and more over years, and 2008 was kind of 2007, 2008 was a bit of an inflection point, and then another one came in 2014, 2015. But startups have been around for much longer, right? Like TCS started in 1968, Infosys started in 1978, HCL and all these companies. So there were startups the way we know of them today. That were getting started in 80s and 90s. So I wouldn't say that I was that much out of the line. And I think two things specifically to your answer. One, I was actually inspired. The story is that when I was in college, my roommate's uncle was a founder of NewGen, which was also a startup back in early 90s and late 80s. And he had come to our college and he was giving a lecture and talking to us. And that's where I learned about it. And that's what inspired me. So it was actually seeing another startup succeed and hearing it from the founder, which actually really turned me towards that. And I thought, okay, this can be done. So there were people ahead of me. Secondly, there are people who are very top down, like who think of like macro and where sort of the opportunity lies, and live life like that and find opportunities within that. And they do very well. I've always been more bottom up, sort of see what is right in front of me, things that feel right to me at that time. So when I graduated in 98, a bunch of circumstances had come together for me to start Pine Labs. I had, just coincidentally, like a connection with Schlumberger, our first customer. So I had some visibility into something to do, even though it was very small, but I had something to do, if I got started. I didn't want to go to the US, which was kind of the default path at that time. The salaries in India were really low for computer science engineers at that time. I think TCS used to pay 1.5 lakh a year. I got rejected from another company, River Run, which was kind of a better paymaster in the interview cycle. So I think, it's a bunch of circumstances got together when I put it all together that, there's an opportunity to do something and the alternatives are not that attractive. So I think all that together kind of pushed me into starting up at that time.
So you mentioned you weren't very excited about going to the US. Any reason for that?
I think it was more personal, I think, than professional. I think my brother had already gone. So I was in India. We had two sons. I think more practically, I was dating, my current wife at that point of time.
Wow,
she was in India. And it was, I didn't really attribute these things at that point, but I do think these were factors for me to kind of, do stuff here. And somehow, I don't know why, but US felt very alien and distant to me at that time. I think over years, it has become closer, and I've obviously been here multiple times, and now I'm kind of live in both places. But at that time, somehow it felt very distant to me, and I was just not in a mental frame. I had a job offer from Deloitte and Touche in Parsippany, New Jersey, and it just felt like, where am I gonna go? Like, I mean, just some random long distance place. Just did not excite me for some reason. Consulting didn't excite me. The offer that I had, I just didn't want to do consulting for whatever reason. So a bunch of all these reasons, I think, just like I said, pushed me into the direction which I thought I could build something on.
Interesting. So on one angle, on one side, you did not really find a lot of clarity or a clear path in terms of what would happen, if you went to the US or took up, let's say, a consulting job or took a regular job. But to sort of weigh on the other side, what was so promising about the opportunity of Pine Labs? How did you really evaluate it as an opportunity, and how did you know this could be something significant?
Honestly, I didn't. I mean, I really lacked the ability at that time to do things like market sizing or opportunity sizing, or to think through what it will lead to. So I wish I had a better story to tell you, a more visionary story, but it was more really bottom up. And I was just thinking that, look, my opportunity cost, if I sort of don't take up a tech job in India, is not very high. It's a couple of lakh a year. And I should be able to make at least that much, even if I'm doing a little bit amount of work, with the opportunities that I have in hand. So I felt that there is not that much to lose. I'll learn something and build something, and let's see where it goes. So the space of payments and chip cards and things like that have always been large spaces. Like, payment is a big space, right? There is always stuff to do there. But I hadn't really done that analysis that it was. I mean, it felt like it's a big enough space, but the direction, the product or service and things like that were just not clear to me. So at that point, it was really, let's get started with something. And also, I think, when you're a fresh grad, your costs are low. I mean, I was literally, my expenses were like 5,000 rupees a month, so I was like, I can make that much. And the opportunity cost is low. I had no interest in doing things like MBA. So I think, again, like I said, it was more circumstantial when I put it all together. And then once I got in, then gradually things unfolded in the way they unfolded, and I found my way gradually, like a little bit like, like that sort of story goes of like sniff and scurry, kind of you sniff and scurry your way to, to cheese, like who moved my cheese I'm referring to. So.
Interesting. So it's just, let's say circumstance led. And how did you look at, let's say, financing or funding for your startup back in the day?
So at that time, there was no real VC ecosystem. This is 98. So this is very early years, and there was no real sort of market for VC. I later learned that there was for stuff like ICICI Ventures, where InfoEdge raised money in 2001. And then there were, Chris Capital had come into being. So there were a couple of funds, but it was definitely not mainstream. And I hadn't even known what it was. So actually, Pine Labs, it was completely bootstrapped, because I had this services work that I was doing with this customer, Schlumberger, and, that paid the bills, that organically grew to 4 or 5 people. And it was completely bootstrapped. So VC funding actually came much later in my second startup, GlobalLogic. I had co-founders from the US who had come, and they were more aware of what VC is, and in the US, obviously the venture market was more established. So actually it was GlobalLogic later on who raised money, and Pine Labs actually never raised money until a long time. I think it only raised money later in 2006, 2007. Yeah.
Interesting. So when you just had some services and your clients paying you, and you were sort of using that to manage your expenses, how did you go about getting your initial team capacity?
So I've generally been, I would say, lucky or maybe good with sort of finding people and working with them. So the first set of people that we hired, actually I remember Sati and Nitin were among the first people that we hired. We had hired from NIIT. So there was a NIIT near sort of where I used to work. And then, in Pine Labs, I had one more co-founder who later joined me, Tarun. His was a 5-year course. So when he graduated in 99, so he joined as well. So we were 2 co-founders. And then we, there was this NIT near us where we just went and, interviewed people and found them. So Nitin and Sati joined us from there, and they were, really good. And we worked together for years. In fact, they later carried on for several years. Sati, I think, is still, I know Tarun is in touch with him. He's here in DC. Nitin, I lost touch over years, but I'm sure he remembers us, and we worked for several years. So it was, it was like that, kind of just very organic, finding people near. Even later on, as we grew, we did go to campuses. We went to DC, then later on use, my own college network, the IIT network, to find people and things like that. So it was because we were young. So, we were not looking for experienced people, we couldn't even, so we were really looking for good people coming out of colleges and things like that. And that is always available, right? There's always people coming out of college, and, you can dip into them and find a few people who can work with you.
So when you say that you weren't looking at, let's say, experienced people or just maybe freshers, but good, what exactly do you mean by good here in terms of, let's say, what were you optimizing for? Was it just technical expertise, or were there specific traits you were looking for? And did you have, let's say, an idea of something like, will this person stick with me for, let's say, 5 to 10 years, as long as this company might run, or until it picks up some momentum or gets some form and shape?
So this was really early years, right, Krishna? So I think we ourselves didn't know we'll stick around for 5 to 10 years, So I don't think we could legitimately ask these questions with any level of seriousness. So mainly we were looking for technical skills and good personalities, people that we could work with, a small office, 4 or 5 people sitting together, so folks that we like to hang out with, generally positive folks, who don't, lose their sort of nerve quickly. And like I said, we remained friends with these guys for a long time. So really those 2 things, just the technical work that we were doing, folks who could contribute to that relatively soon. And second was people that we just like to hang out with, like a small team, we could have a conversation with, met our sensibilities, food habits, things like that. Just basic stuff, like just folks that you like to hang out with. Yeah.
So when you mentioned, some kind of lack of assurance in terms of you yourself being able to stick around for a long time, what do you think you did right in those early few months or years that allowed Pine Labs to grow into what it is today?
We really, I would say we focused a lot on execution. Like I remember, the first version of Pine Labs where we were building these petrol pump type of solutions where you could use a petro card to pay. It was the first chip card in India. It was ultimate customer was Bharat Petroleum, and Schlumberger was our intermediary because they were selling terminals and cards at the time, and we were doing the software. It was a complex project for that time. It was not technically simple. I remember going to Bombay for the certification and testing, spending months getting it tested, monkey proofing it, all kinds of things. So I do think we focused a lot on just execution, brass tacks, fulfilling what we promised, we were working hard, being generally fair to everyone. And then over a period of time, being nimble, like over a period of time, I think one of the big achievements I would say I had in 2003 was that I got Lokveer to the team. So Lokveer was our customer at Schlimberger, Lokveer Kapoor. And he was a real business person. He was a early 90s graduate, or maybe even late 80s graduate. So he knew the market. We were just techies, coders, honestly, at that point of time. And he knew the market a little bit, what strategy is, where to build, how to build, I think my big achievement was to kind of attract him to the team. And he joined as CEO back in 2003. And I think that really after that, I would say Pine Labs really became a real company. Then sort of we started building teams, and he was there, I think, until 2018 or something. So he spent like a good 14, 15 years kind of building the company before, other CEOs came in and stuff like that. So I think, but this also shows, I would say now I look back, I would say a certain level of maturity to be able to get somebody like him, create space for him, attract him. And I don't see many founders even today being able to do that, in even well-funded companies and things like that. So I think these are some of the decisions which are really key in hindsight. I don't think it would have gotten this far if we hadn't, for example, gotten Lokveer at that point.
This is very interesting, and it kind of forces me to ask, why do you think most founders aren't able to get a Lokveer for Pine Labs or a Chamath for Facebook? Because there seems to be, one individual who comes in at, let's say, 3 to 4 years since the inception of the company, who really sets the company on a different trajectory and sort of prepares it, let's say, for sustenance in the long term, or just be able to cater to the market as to whatever the demand might be. What do you think you did right, or what do you think founders are doing wrong in terms that's not allowing them to get in such talent?
I think culturally, I would say first is just cultural reasons. I think as people in India, we are far more, I think, emotionally attached to the companies that we found. We find it's just like kids, right? Also, we are more. I mean, we find it hard to let our kids go, right? Even after marriage or colleges and things like that. I mean, my parents found it hard, and I know most parents find it hard to kind of part ways with the kids. So I think companies are like that. The role models that we've seen historically, the business families, like the Tatas, Birlas, Godreges, Ambanis, they tend to be more generational businesses, where somebody sets it up and then the family takes it forward. And those are the stories we've read growing up. Those are the role models that we've seen growing up. So that's kind of the natural, I think, inclination of founders historically, that, I'll run the company forever, and maybe somebody else, my children will take it over or whatever. Maybe even if they don't say it explicitly, but it's in our cultural DNA. I think it's changing, as more and more role models come up now, like, the Flipkart case where Sachin and Binny moved out and they're doing new businesses. And there's so many other, Mukesh Bansal, Mitra, and, so many others now. Over the last 15, 20 years, where people have successfully exited, moved on, on their second companies, third companies, funds, this and that. These role models will become more apparent to people. They are already more apparent, but as we have more and more of these stories, I think entrepreneurs will follow suit, and we will see a lot more of this happening. It is already happening more than it was happening in 98, but I do think it'll happen more and more.
So in a way, you think it's part of the reason is because founders tend to make the company founder-centric and not necessarily company-centric or survival-centric.
And it's a balancing act, right, Krishna? I think, founders do bring in a special something to the company. Right. I think there is, call it the soul or culture or something, deeper. There is like, I've done a bunch of work with Sequoia, and, a bunch of people have told me there that, you never make money in companies where founders leave. So they have data over 50 years. So in general, I think founders do bring in something special to companies. So you can't take that away, but at the same time, there is obviously the same things that they bring to the table sometimes also become limiting, and there is value to professional leadership. Internationally we see a lot more of this, right, with Google and in fact folks like Amazon, Jeff Bezos and all are exceptions. Most companies, where young founders start a company, they bring in a professional CEO in a few years as the company gets a little bit bigger. And I do think there's merit to that. So it is a balancing act. I wouldn't say that it's an absolute that founders are willing to not let go or something like that. But it is a balancing act which is not easy to get right in the context that you're in all the time.
But how do you develop that trust factor with that one individual and sort of get that conviction that this person might treat this company like he or she is the founder of this company and maybe give more life to it?
I think one has to cultivate relationships. Like in our case, I knew Lokvi for several years because he was our customer. So I was working with him for as a vendor for multiple years, at least 3 years before he joined. So this conversation went on for a couple of years where I could see that he was excited and he was in his own head and his own right an entrepreneur. Like he wanted to always start his own business. He saw this as an opportunity to join a fledgling business and take it to places, kind of starting from rank zero. Instead of starting from zero, it's like starting from 0.5 or 1, right? So I think it was I feel cultivating these relationships are extremely important. It's very hard to trust somebody through an interview process, where you get up one morning and say, okay, I'll hire a CEO. I think it should take at least a year, maybe more, for you to find the right person, get to know them well, and be absolutely sure. So I think investing time, but also I think just motivationally keeping your eyes open. And generally, I feel as an entrepreneur, one should always be looking for good people in all different kinds of capacities. And if you do find somebody who's appropriate for a certain role, even if it's the CEO, and that's the right time to kind of pull the trigger. So I think it starts from motivation, and then it's just nurturing and building those relationships. I think it's hard if you just one fine day like run a recruitment process and I'll get a CEO in 3 months. That's, I think, prone to failure in many different ways. Going to me.
Sure, but there's probably more to this, right? And let's say you got Lokvi into Pine Labs at one point, and you developed that trust over the years and formed that relationship, and then Lokvi has been proving your decision over time. Now it's one thing to hand over things to another person, but it's another thing to sort of believe in that completely and just exit the company. So what was that binary thought process, or was it more gradual that you had in mind that gave you the conviction to jump out of Pine Labs?
So again, it's a combination of circumstances plus, little bits of top down here as well. So in my case, we had a bit of an overlap between the two companies, Pine Labs and GlobalLogic. So after I started Pine Labs in 2001, we started GlobalLogic, and I ran the two kind of in parallel. GlobalLogic had four co-founders. I was one, and the other three. And then, because I was in both, so I mean, Pine Labs was a little bit of it wasn't getting much of my attention. I was mostly focusing on GlobalLogic, starting from 2001, but the business was doing okay. It was gradually growing, and I felt that if somebody really ran it, they could make something of it. So that also made the Lokvi decision a little bit easier. So when he joined in 2003, I had to make a choice at that time to either go completely in Pine Labs or to go completely in GlobalLogic, because you can't really be in two boats, forever. You can do it, for a little bit. So I chose GlobalLogic, because it was really growing fast at that time, and I was enjoying the quality of work and things like that. And I stayed on Pine Labs board for a few years. So I stayed until 2008, 2009, at which point I sold to Sequoia as they came in and kind of recapitalized the company and things like that. And I continued to stay with GlobalLogic. So it was again a combination of little bit circumstances. But even just to sort of answer the spirit of your question, We did also hire a CEO in GlobalLogic, Peter Harrison, who I reported to for many years. And again, great guy. I think I learned a lot from him. And, we did, hand him over just completely. We were all four founders. We reported to him. Again, I think in this case as well, he had much more market knowledge, much more, experience than any of us did, and was invaluable to the team. Eventually all of us exited as well. So I think at some level, as the company grows, these opportunities present themselves more and more as well. It's very hard to do it when the company is really, really small or very early. But as you build up organization and, you see companies succeeding, these opportunities present themselves even more. But we had the intent. I mean, we were willing as founders, both in Pine Labs and GlobalLogic, to be able to bring in people, who we felt were right for the business.
But one thing I would want to ask at this point is, when you started off GlobalLogic while at Pine Labs, did you at some point intend that GlobalLogic would be a subsidiary of Pine Labs, or why exactly did you go about picking another boat while at Pine Labs?
So Pine Labs was a very domestic business. It was really, really small. Even when Lockheed came in 2003, we were barely doing $500,000 in revenue, like 5 years in or something like that. So it was really small business. 2001, it was even smaller. So it wasn't really going anywhere. Versus, the vision that we had for GlobalLogic at the time when we started, late 2000, early 2001. It seemed exciting. There were like a lot of B2B exchange products going on, and it was more global. It was all US centric for most part. By this time, I guess I could do a little bit more of market sizing, opportunity sizing. And and India is a challenging market. Even today, SaaS entrepreneurs, B2B entrepreneurs talk about it, as a small company working with large customers like BPCL, Schlumberger, was not easy. You could do a lot of work, but to get paid anything significant was really, really hard. They would squeeze you basically on every dime, because they just looked at you as coders, essentially. So they wanted to pay you kind of coder salary, essentially, plus, versus any real value add. So I think I honestly didn't feel for a bit that Pine Labs was going anywhere. So in my head, when we did GlobalLogic, I was thinking that this is kind of a pivot for me, and we will focus more on GlobalLogic. I will focus more on GlobalLogic, but Pine Labs kind of refused to die. It kept on growing a little bit, and then kind of Lockheed thing happened, and then it kind of took off.
Yeah. So one thing that about Pine Labs and GlobalLogic that's interesting to me is you sort of exited as part of a venture deal, right? And it's not that the company itself sold to an entity. So how does this work, and how did you evaluate this option as opposed to, let's say, just retaining your equity in the company for a longer period of time while you just exited in any capacity?
So one, I was a first-time entrepreneur. I hadn't seen any capital ever in my life. I eventually in GlobalLogic, I had a salary, like a normal salary for those times, 2006, 2007. But I hadn't really seen any capital. I was married, had kids, and I think was yearning for some liquidity. I didn't really know what money feels like. So I think so that was definitely a factor. I think the bigger factor was that I wasn't really doing anything in Pine Labs anymore. There was my role I was on the board, but there was nothing for me to do. So I just felt that I'm holding on to this free equity. Fine, I started it, but I think the company has moved on. It's bigger. These guys are working hard. There's employees, there's people, there's a VC fund which is coming in. And generally, VCs also, don't like debt equity on the cap table. They like active equity, which is like with people, employees and management, founders. They like active investors, who can potentially exit or put in more capital. And, now I'm in the VC shoes, so I understand this better. But let's say we invest in a company where like a sleeping founder is holding, 10, 20%, then that just feels wasteful. It's better to kind of buy them off or reduce it or, do something else with that equity. And I intuitively, I think, got it. And the fact that I wasn't doing anything in the company, I felt is the right time for me. So I think, again, sort of a combination for those reasons. Yeah.
Interesting. So is your approach towards, let's say, liquidity or capital any different today, now that you've seen it all back, as opposed to, let's say, back in 2008?
I think it is definitely different for multiple reasons. I'm at a different life stage now. I've also seen a few exits both as investor and as entrepreneur. So I don't have that kind of liquidity needs also. In that sense, I don't need money to like buy a house or bring up my kids or things like that at this point of time, thankfully. So I think that's one factor. So I'm able to look at it more as a portfolio of assets that I have invested in. And then I can take a more financially prudent decision, hopefully, that hold on to assets which are expected to grow, sell assets which are sort of, let's say, not growing as fast or sometimes in distress, things like that. So I'm able to take a little bit more distanced, prudent financial view to some of these investments today. Versus at that time, which was kind of more governed by other personal factors and stuff like that.
So this fact that you mentioned that maybe liquidity isn't so much of a concern at this point reminds me of an article that you had recently written where you speak about how investors should typically write off companies when they are writing checks or making investments. And what do you have to say about that? Like what's with this? How do you get the confidence to write off a certain amount? Does it come from a place that the amount is a very small part of your portfolio, or the total amount you're investing? Is it because the risk itself is low, or even at high risk, do you go ahead and make that decision to write it off?
So I think in early years when I was angel investing before Leo, from 2012 to 2012, I started, I think. And before I started Leo until 2018, I was investing my own capital. And that tended to be small. I think the smallest was like 10, 15 lakh. The highest would be like 1 crore. So normally maybe 20 lakh, 25 lakh, 30 lakh, and I did a lot of investments. I made like 26, 27 investments, I think, overall in that period of this nature. So, it's not actually as much the risk and things like that. I think it's the nature of the asset class. When you're entering a company that early, where there is really nothing to see, it's basically founders, and a dream, who are looking to do something, and you like the founders, maybe you like the space, maybe you like some things that they've done, but it's very, very early. If you just look at the statistics, a lot of those companies completely fail. Like I think I wrote in my article that about a third of funded companies completely fail, go to zero. So it's the nature of the asset class. So it's like, if you're playing cricket, then you have to play by the rules of the game, right? You bowl a certain way, you bat a certain way. So if you are making early stage investment, that's a rule of the game that you will need to write off assets, when they go out of business. So it's better to be mentally prepared that, I have to, at the right time of writing the check, you need to know that this can completely go to zero. I think what I alluded to in the article is that as markets got flush with money last couple of years, and it always happens, a lot of folks got into early stage investing who had never done early stage investing before, and they may not continue it. And these are all kinds of capital, people who are earlier doing public market investing, people who are doing late growth stage investing, and entrepreneurs, angels, things like that. And, and they're smart people. I think, I'm not saying they're not smart and they're successful in their own right, but it's a different asset class. So they may not have completely recognized what the asset class is. And in other asset classes, like when you do public market investing, normally you don't go to zero. Right. I mean, in a normal case, you might lose 20%, 30%. You can hold on to it, recover. In the worst case, you lose 40, 50% of the market is really tanked. Then you really kick yourself. But still, you just hold on to them. But in early stage, there's no recourse. Once a company is out of capital, there's nothing to do. You have to just completely write it off.
Yeah, you deserve
and just culturally, it's a very alien concept to many of these investors. And I think, so it's just the nature of the asset class, which I think needs you to think that way, that, you will have to write off a bunch of the assets completely.
Right.
And you should be okay with
one thing I gather from what you mentioned is the nature of this asset class is primarily because there's nothing much to evaluate at this early stage, right? Except for maybe the fact that you like the founder or maybe the space that they are interested in. So that brings me to the question, how exactly do you evaluate, let's say, the amount to be invested, or just evaluate the startup at that point? You mentioned that your early investments were anywhere between 10 to 15 lakhs and going up to 1 crore. So how did you know that it's worth investing, let's say, 20 lakhs here, or maybe 40 lakhs here, or 60 lakhs here? How do you make that decision?
So I think, you obviously have to like the team. Again, you have to believe that these founders have the hunger, the abilities, and the ambition to build a business of this nature. I think space is an important one. That this the timing. Like there was a time to do e-commerce, there was a time to do logistics. There's a different time now. Doing certain kinds of businesses which are, let's say, topical today. Based on the macro environment and things like that. So I think the timing and the macro environment needs to kind of align. At least that's how I think that, it needs to push you in the right direction, that you can build a business in that space in the following 10 years. So understanding of the space is very important. A little bit approach of the founders towards the business, what their sort of traction, like business model, or like how they're going about it. Is it consumer centric? Is it business centric? Does that work? So these are kind of early signs where investors build their own experiences and theses. None of them are honestly right or wrong, but they're just driven by their own. There is a little bit of art, it's not purely science, the early stage investing, and, so people based on their experiences built up these theses. So I think that's how you do it. I think the amount question, I would say one thing I learned was that, company needs to be capitalized enough. To make enough progress. So let's say, a company needs 2 crore to make enough progress, let's say for the next round, then there's no point in funding it, 50 lakh. Right. Your chances of success are much lower because they'll just run out of 50 lakh and then, they'll have to go back into the market. So I think depending on the business, some businesses need more capital, some need less capital. So if the round itself is bigger, then, it's better to put in a little bit more capital and support that. Versus the round itself is smaller. Then is the risk profile. Like for example, I did this company very early as an angel. My first angel investment, Cygnus Medicare, which was a hospital chain. And they were like an OYO for hospitals. So they would aggregate hospitals and start operating them. And I would say, they had already, when I invested, they had a couple of hospitals. And I felt that the risk is very low in this business. I felt that, it's unlikely that this one is not going to be a write-off. Right. Like in the worst case, it will not grow as much, but, it's a healthcare business. They have 2 hospitals running. There's no real product market fit risk and things like that. So I wrote a large check, because I thought that, the upside might be limited. It may not be a hockey stick, but the downside is very limited too. So I think the second is the risk profile. So I think it's a combination of level of capital required and the risk profile and the outcome that you're seeking as a portfolio. I think those 3 things kind of, determine usually the check size as an individual and even now as a fund, I would say.
Got it. So you were telling me that it's sort of a trade-off between the risk involved as well as what is the capital that the company might actually need. So when we speak of, let's say, what is the capital the company might actually need to show some progress, and on most stages, let's say it's at the idea stage, and has not really, come up with a product, or maybe the PMF is not visible yet. How do you evaluate such scenarios? Is it solely based on the founder and the space, or is there more to it? Because, and let me follow this up with one thing. Is the reason I ask this is primarily because we know for a fact that many companies that, let's say, raise seed capital, most definitely go ahead and pivot at some point, and maybe they stick to the same space, but maybe the proposition is different, maybe the target audience is different, maybe the revenue model is different. So there are many variables involved here. How do you look at it?
So pivots, I think, are impossible to model as an investor. While making an investment, I don't think one can kind of factor in that a pivot will happen and something, because you don't know what that pivot is going to be and what that, is going to look like. So you have to look at stuff at hand, which is the current business model at the time they're pitching to you. And the metrics are, somewhat metrics are, you can sort of have target metrics in your head. So for example, let's say, when I did Misho, this was 2015 as an angel, and at that time, the bar for internet transactions, believe it or not, was something like 100, 150 transactions a day. If a company was reaching 100, 150 transactions a day in a short enough period of time, you could say that it was kind of Series A worthy based on, last year or two of data of the kind of stuff that had been getting funded, So if you think of like what it will reach a company like that, take a company like that to reach 100, 150 transactions, build some buffer, 200, 250, how much time it will take, what kind of capital take roughly, you'll get a sense of what the capital is. Now, of course, if during that time, the company determines that that model is not right and they completely pivot to something else, I really don't think you can model that as an investor. But yeah, so similarly, like if it's a SaaS company, let's say, which is in vogue these days, then you can kind of do the math of what it takes to get to, let's say, 200K, 300K in ARR, which makes it worthy of a seed plus round, or 500,000 in ARR, which makes it like a sort of pre-A type of round, things like that. So, I mean, depending on the current environment, it's not that hard to kind of see of what it will take to get, like in today, we are generally cash tight environment. So I would say that when we're funding new companies, we are thinking that we should fund them for 2 years, like 23 and 24, just so that we are not in a situation where, they have to go out and raise in a market which is still, let's say, really tight. So hence, in our case, when we're funding companies, we are actually targeting slightly larger rounds, which is a little bit unintuitive, just because we feel it's better to have a little bit more buffer capital for a couple of years versus, let's say, 12 to 18 months, which used to be the case, let's say 2 years back, because there was so much funding happening within like 12 to 18 months. So these are all, I think, also factors that you factor in.
Interesting. I want to come back to that, but before that, since you brought up Misho, in an earlier response, you mentioned about how there's a certain time frame and a timing for the market, where there was a period for e-commerce and maybe there was a period for consumer marketplaces and stuff like that. And maybe Misho was, let's say, last to the party of e-commerce or social commerce, so to say. So at this very late stage, which is way off the typical standard timing, how do you develop the conviction? And you mentioned that at that point 150 transactions a day was a rather stronghold for any company to prove themselves. But in order to even, let's say, get to 100, 150 transactions a day, there would be a requirement of a certain amount of capital, which typically comes in at, let's say, the pre-seed or the seed stage. So do you say that it's meaningful only to make, let's say, seed plus or Series A plus investments in such companies, or would you go ahead and make a bet in at the pre-seed stage?
So this was kind of a pre-seed stage in case of Misho, but I really liked the model at that time of social commerce, the way they were approaching it, working with these social resellers. It was very new, but it was showing some traction, very early traction over the previous 3-4 months that they had kind of pivoted to this one. I had my own thesis, rightly or wrongly, from 2011, 2012, that there is a large women force in our country, which is underutilized, and there can be businesses which are can be built around that. So I was specifically looking at that theme with more interest. So there were other, like, for example, in Sunstone, we used a lot of women workforce working from home at the back, which was working really well for us, on the same thing. I invested in Shiro's, which was another kind of women network. Then I invested in Misho again, because it was kind of, there was a women sort of reseller component to it, which sounded attractive to me. So I think, so there was somewhere this thesis in my head that, the women workforce is a very valuable asset, which can be channelized, in a country like India. And they were showing some early traction. So, it's a hard one to do, I would say, generally, like a Misho-like company, because of what you said, late to the party and, competitive market, capital, this and that. But they had a unique approach to the market, which at that time, nobody else had. There were a couple of other companies, Woopler, this and that, but they were very distracted and they were doing, all kinds of different things, versus with it. And Sanjeev and Misho had a very, at least at that time, what felt to me, a very sort of clear-headed approach towards how to tackle this and build some early traction.
Okay, but what I pick up repeatedly from this is the fact that they showed some early traction, which gave you conviction that, okay, this approach might work. But how do you look at it, let's say, at an idea stage for a company? Firstly, do you invest in idea stage? And if so, how do you evaluate it at the idea stage when there is literally no traction or not even, let's say, an MVP? Except for maybe a prototype in some cases.
Right. And so I think the way it works for me, I think, and again as an angel and now as a fund, I mean, we can only do idea stage, I would say, when we just strongly believe in the market itself. Like we should see, let's say if it's kind of a given, right? Let's say that the market, let me take an example. Let's say if you think of, let's say, these X for Y type of companies, like Thrasio type of companies, which got funded, in the last
Right.
couple of years. I think investors kind of believe that that's kind of a given, and it's really just an execution play. There is no product market fit risk as such. It has happened in multiple markets, and all it needs is capital, but it requires a lot of capital. So hence you would see like a lot of seed level, lot of funding came in.
Right.
Even when anything was there, because people just believed in that macro so strongly that it would happen. So similarly, if we came across something where we really believe in the like for example, we did last year a company called Elevate, which is in the sales commission SaaS space, and we really believed in the sort of problem and the product. So there was no traction. It was kind of idea stage, a pre-revenue, pre-seed kind of deal. But we liked the founders and we had conviction in this space. Again, rightly or wrongly, based on our own experiences, from what we had seen, we felt that there is a real market gap and a product can be built. And there is some product market fit risk, but not, we could see the need. So I think those are the cases where you can do idea stage, where your own conviction on the space is very high as an investor. Yeah.
Got it. So it's not necessarily a thing of product market fit, but it's, let's say, more of founder market fit that you look for in such companies, especially when you're building for X for Y. It would require a certain amount of experience for a founder in X or something similar to X, so that they can try and replicate that in Y.
Yeah, correct. So I think either X for Y, or based on your personal experiences, you have conviction in that space, market problem, for whatever reason, and folks are coming, or even sometimes nothing else, but you just know the founder, right? Like really well. And the founder, you want to sort of invest in that founder. You believe that this founder will figure it out. I think a bunch of, like, if you look at something like, let's say, Cred, right? Kunal Shah and all that, I'm sure a lot of the money that initially came in was just on his credibility, because of free charge and this and that, where the business was maybe clear, but not that clear, and did not warrant that kind of capital at that early stage. So I think in some cases it can just be the founder as well. But otherwise, it's normally founder plus space, strong conviction on the space when you're making idea stage kind of bets. Yeah.
Interesting. And how do you, let's say, evaluate PMF in companies? Or let's say they come with a certain amount of traction. How do you know that this very early traction could be promising enough?
So again, it depends a little bit on the space, because the traction parameters are different in different spaces. So for example, if it's a SaaS company, then the metrics are generally well established these days, like your CAC, your marketing channels, your reach, then, your unit economics, your ACV, your average customer value, ARPU, whatever, margins, gross margins, growth, ARR, churn, so I mean, actually in SaaS, you can plot 8-9 parameters on an Excel. And, since all investors have seen a lot of SaaS companies, they can even compare, and a lot of data is available, from larger funds of what is good early stage investment, what is bad early stage investment. So that has informed a lot of early stage investments in SaaS specifically, just because, it's a more understood space in terms of metrics. I think when you do consumer and things like that, it's less obvious, because each consumer business is a little bit different. And when you do innovation, then it's even less. Like, for example, we did this company called Beto, which is in diabetes care. I think they're kind of a leader in diabetes care now. They just raised 33 million a couple of months back. And I would say there was no precedent for that business. We funded it in 2018 from Leo, and they were doing, glucometers, and then there's an app, through which you self-manage your diabetes and things like that. And there was no X for Y. There was no, clear precedent for that. So it was sort of an innovation which was very local. So when you look at those kind of businesses, then you have to, establish new PMF metrics, like what they are, what they need to sell, what, how their unit economics are trending, how their retention is trending. And it's harder when you're doing something which is entirely new. And hence actually investors shy away from doing things which are entirely new. I mean, investors feel safer in stuff which has been proven before, and you can point to metrics and stuff like that. So it is space centric, but each space has its own, like for me, I said 150 orders a day, CAC, things like that in those years. So I mean, when you sort of, for each space has their own sort of metrics in that sense.
Maybe I've answered this as part of the previous question, but I would want to emphasize and maybe extend this conversation ahead, right? How would you, let's say, evaluate the growth metrics or the performance metrics of a company that's sort of trying to create a new market? It's maybe not a necessarily market that exists. It's trying to create a new category or maybe a new market. How do you evaluate the metrics in that case?
That's a really hard one, Krishna, to be honest, because one, it's really hard to invest in something which is entirely new. I think honestly, in the VC venture ecosystem, there's a belief that there is nothing entirely new, and there is like a deep amount of questioning, of like, if you're really doing something entirely new, is there even a market for it? Like why, like there are a lot of these questions of why now, why was not this done before, if there was a market for it. And other proxies are, if there is no competition, then why is there no competition? Is there really a market for it? And things like that. So I think generally, I would say it's a pretty scary investment to make when it's an entirely new investment, and most VCs do only a few of them, if at all. I think the traction metrics and PMF for that are usually around market adoption, discovery and adoption, because sort of the whole pitch is that the market is growing into this product. So how do you measure that? So for example, things like, let's say, Google searches. So let's say you say that I've created a new, hair gel, then I think, or a hair implant, which can be used at home, so it's a new market, like people are not doing hair implants at home today. So are there Google searches happening for hair implants at home? So if you see that there are a lot of Google searches happening and they're growing, as a trend, then you can say, okay, there's a market which is growing. And then over a year or two, you can see that it's growing more and more. There's some sort of intent, for example. So I would say then the PMF is more around this kind of stuff, like market adoption, market searches. Are people looking for this? Even if it's not you, are people looking for this? Like Beto even today, because it was innovative and it is innovative. I mean, their pitch, if you see, is, if you go to the website and campaigns, is aapne sugar check kari kya? So they are promoting self-management of diabetes, basically. They're not even promoting Beto, because they're trying to expand the market into a self-managed diabetes market, because they feel if that market grows, they will get most of the share of it. But that's their attempt. They're not saying that use Beto for sugar, because, that market itself is kind of tiny. Or has been small historically.
So this particular thing that you mentioned about, right, like identifying relevance or the potential for a market based on, let's say, Google searches or some data available from on the demand side, is when we would really identify the market. Maybe if we go back to the case of Google, where they told, searches for sure demand exists, but how do you demonstrate the demand for, let's say, relevance? Or when Gmail came into the picture, one of the things they told was, okay, people get emails for, it's mostly personal stuff. Why would anyone want to delete it? And that's why we coming up with Google Drive storage and stuff like that, right? And these are, let's say, bold claims to make, and which seems logically right and maybe rightly so, but there's no real proof for it early on.
Right.
So how would you make sense of statements like this? And the reason I ask this is typically, when, let's say I'm filling out, let's say, a YC application or a Sequoia accelerator application, one of the questions that anyone asks is, what is your unique insight, or what is your right to win in a certain space, right? So how do you, let's say, arrive at a certain aha moment in a space?
So back to the first part, I think when you look at the very large companies, not the first Google version when they were creating the new search, but later on when they create the G Drive, Gmail, this and that, right? I think the very large companies can undertake market creation activities because they have the wherewithal and the resources to be able to at least, impact that. Like a Google, Microsoft, Amazon can take it on. they can invest the tens of billions of dollars in promoting it, and sort of creating the technology and things like that. If they feel that ultimately the market, and sometimes it goes wrong. Like if you look at the Meta case, where they sort of put a lot of resources
And
in the VR, and then later on Meta, and that hasn't really played out so far, right? So it can also go wrong. But if they get it right, then they can capture like a big share of that market. So I think as a big company, I do get it, but think of it from a startup perspective. Under-resourced, understaffed, under product. How do you take on like a market creation activity as a startup? It just feels extremely daunting, to be able to take that up. I think back to the unique insight question in these applications. I think, and again, it's very hard to sort of see how people evaluate these things. Everybody has their own, when you have these forms, you have to put something there, and you have to kind of, put people, force people to think. But I think people are looking for focus more than anything else. That's something which is a little bit more real versus, there's a lot of floozy stuff out there, right? Like I'm doing something in healthcare. Healthcare is these many $1 billion of industry, this and that, right? But like, how can you narrow it down? I think most investors think that the 0 to 1 problem, right, of like how do you go from 0 to 1 is a lot more about focus than about market. The 1 to 10 problem is a lot more about market. So as an investor, I mean, ideally we're looking for these two things, right? We're looking for both 0 to 1 and 1 to 10. And the way you evaluate 0 to 1 is that unique insight question, right? Like what is today, in the next 9-12 months, what is that unique thing, insight that you can do, like that you can lean upon, which will get you some success, right? And then if the market is large enough, then hopefully there'll be a 1 to 10 journey, so that's where the market sizing and option sizing question comes in. So I think that's my interpretation of the insight question, which is really the underlying is that what is the 0 to 1 journey here? What is the, how do we believe that there is a 0 to 1 journey here?
Got it. So you were telling about 0 to 1 journey being sort of the critical decisive factor for identifying how the company's 1 to 10 journey might look like and if it might be present in the first place. So maybe just, drawing strings back to the earlier discussion on, making that hire, let's say, Lokveer for Pine Labs or, Chamath for Facebook, and similarly so for many other companies. Do you think sort of bringing in this person or that new person who's supposed to lead the organization, the right time to bring such a person would be at, let's say, once you've hit 0 to 1 and maybe you want that person to take it from 1 to 10? Or is it just
I definitely think 0 to 1 is a founder's burden, to carry. I think it'll be very hard to attract like an entrepreneur, like a professional, in the 0 to 1 journey, just simply because, I mean, that's kind of, it's just too risky, at that time for the professional. There's not enough resources, things like that. So, you may find exceptions once in a while for a variety of reasons. But in general, I would say 0 to 1 is the founder's burden. You have to kind of get that done, get like ideally like a Series A done. Let me put it this way. I think as a founder, you need to be able to take it at least to Series A, maybe closer to Series B, before, in today's market particularly, to be able to hire good quality professionals to your team. I think attempting it before Series A is hard. I think then it's kind of like really like finding another kind of co-founder in some sense,
Right.
Maybe small co-founder or whatever. Yeah.
Interesting. And how would you, let's say, look at investing in multiple companies in the same space? Because one thing we would have noticed is if you take any space, let's say food delivery in India, that there's two giants over there. Let's say Zomato and Swiggy, or any space that you take, there would be at least two players that might really play it out in the big sense. So early on, do you try to invest only in one of those, or do you try to invest in two companies that you think might be market leaders just to hedge your risk and maybe have a higher upside? How do you approach that?
So we are a small fund, so we don't really invest in competing companies. It's just too much kind of too traumatic for us, and we put all our weight behind kind of the one company that we have backed. Like, I mean, realistically, for example, we did Bulbul in the video commerce space 3 years back, and there were 3, 4 companies funded at the time. Unfortunately, none of those companies have really broken out, but we got the opportunity to see all 3 or 4 of them. And, we picked the one that we wanted to partner with and got it. And similarly, everyone did that. Like Sequoia was in Bulbul, Ceph was in somebody else, Axel was in somebody else. So there was like 3, 4 companies that got funded by 5, 6 VCs. So generally, I would say VCs don't like to go head on in portfolio companies. But unless you're like Tiger, right, which Tiger does that all the time. Like Tiger has a very different thesis, and because they're passive investors, they don't get involved, right? They kind of write the check and don't even take board seats and things like that, right? So unless you are structured to do that for normal VC funds, it's hard to get through into directly competing companies, but the space can be of interest. So to your same example, like if you're doing cloud kitchens, for example, I could invest in 5 different brands. Somebody's making spaghetti, somebody's making pizza, somebody's making kebabs, and they're all selling on Swiggy and Zomato, So if I'm doing consumer brands, then in that space, if I like, I could make 5 investments. There's nothing stopping me. But if it's a directly competing Swiggy, Zomato type situation, then I doubt people will come in.
Right, but since you brought up the video commerce space and you got an opportunity to interact with all the 3 or 4 companies in that space, and you mentioned that other leading institutional investors have invested in one of those companies that you have passed on, right? And it's also true that those investors are also smart enough, and they have also chosen the one where they feel the odds of winning is rather high. So in some sense, the competition sort of sets in very early, where you're competing not just with your conviction, but the conviction of another person who, to a fair degree, is also smart enough in making a decision. So how do you get the confidence in your decision at that point?
So in general, if you look at any space, right, you look at e-commerce, food delivery, video commerce, any like large internet space, taxi, Uber, Ola type of space and all that, right? If you see the genesis of the space, then usually I would say in a market like India, you could, I would say, seed fund 4 or 5 companies in any space, and let's say Series A fund 3 companies, 4 companies even, right? Series B fund 2, 3 companies, and then couple will break out. It's never like really one company, right, which will only get funded from seed to all the way later, right? So I think if you are in that bucket of in a new space, there's certain belief, then I think most investors would be happy to fund a few companies, 4, 5, 6, even at early stages, and that will gradually narrow it down, to a fewer companies. Like even in taxi, if you see, there was Taxi for Sure, and there was like a bunch of other companies, like 4, 5, 6 companies that got funded, even in those years. So in some sense, it's also actually validating that if other really smart people are investing in that space, then something must be happening in that space. So I would feel actually comfortable investing in a company where, let's say, an Axel has invested, and I feel that the market is not crowded today, and that space can take, 2, 3 more seed investments, and I like the team. I would feel actually quite comfortable and even, sort of bullish about, okay, Axel invested there, and, we can invest in one more, and, there is possibly space for a few companies.
Interesting. And you mentioned part of some of the companies that came up in a 2018 timeframe in the space of video commerce haven't really broken out. And why do you think that's so? Is it just that the video commerce space hasn't matured, or what do you see about the future of, let's say, video and live commerce, at least in the Indian context?
So I do think video commerce, live commerce should grow as a category. I mean, we were all inspired by China also. I think all investors at that time, China, was kind of a little bit of a place that everybody looked to for internet companies because of similar dynamics, large middle class, much larger internet companies and things like that. I think the issue is that can you create third party companies, or will live commerce and video commerce exist inside the existing large e-commerce companies, right? Like Flipkart, Meesho, Amazon, this and that, right? I think when you do third party companies, then you incur the same cost base of like, creating the content, CAC, of acquiring customers and things like that. So it becomes a really expensive business to run. All these companies between them, raised $50 to $100 million. Bulbul raised $15, $20 million, but it was nowhere close to, what it takes. Like if you think of, let's say, Flipkart, right, how much money it burned through, to get to a certain level, or even Misho, in today's date. So, I mean, it just does become a very, very capital intensive business when you're trying to build a B2C product. It's like a third front then you are competing, for commerce with all these companies. So while I do think the live commerce, video commerce, it's all influencer commerce, it's all here to stay. The question is, can you create an independent third front, which is what all these companies attempted to do in those years, and ended up just finding that it's way too expensive eventually.
But do you think it's just that it's way too expensive and capitally intensive, and maybe trying to struggle to take one of these giants head on? Or is it more a fact that the market itself might not be ready in terms of the demand not existing as expected?
I don't think at least these companies made enough progress to get to that point. That I don't think, in my view at least, that these companies became big enough to test the market demand in the sense that you're talking about. They kind of all fizzled out before that. The volumes were never that high that they could really, really make a mark and sort of test the market. The other angle from which, by the way, also some of these companies, as they were fundraising, the other angle that came in was all these video companies, right? Like ShareChat, Mod, Josh, Takata, this and that. And they all had like this new format came in, right, in kind of 19, 20, 21, in the same years, and had a lot of traction. So there was also a thought among investors, and TikTok had demonstrated this in other markets, that they will start doing the video commerce, because they have the traffic and they have the videos, and they have the influencers, and they will start selling products, which to some extent has started happening. I mean, TikTok is doing it very successfully in China and in the other markets. We see it in Southeast Asia. TikTok is, again, very aggressive in Southeast Asia. We have another investment in Singapore, Upmesh, in the video commerce space. And, so we kind of encounter TikTok all the time. So I think it's not clear, again, of where this front will be created. I think perhaps the content companies will become more video commerce companies over a period of time and create that third front, which seems like a likely direction many investors believe, I would say.
Interesting. And how should, let's say, before we conclude, one last question, or maybe two last questions, particularly if you're building a consumer first business and not necessarily a B2B business, how do you go about demonstrating early, promising metrics, at least from an investment standpoint? Or if I were to rephrase this, what would you look for in a founder before doing, let's say, a pre-seed or a seed investment? Or what should founder bring to the table and show to you so that it's convincing enough?
So for me, in consumer businesses, and I'm not talking about brands, and they're brand businesses, right, which you can sell on Flipkart and sort of sure. Amazon. They're different consumer businesses, right? They're brand businesses, right? But if you're like marketplace type of business, selling internet consumer
platform
businesses,
let's say.
Platform businesses and things like that. For me, I think the key innovation is in GTM, in go-to-market. Like, again, going back to Misho, I felt there was a key reseller innovation there. If I sort of do just apple to apple, acquiring a consumer directly costs X, acquiring a reseller costs Y, but, then that reseller can acquire far more customers, So for me, I think just finding a way to acquire customers, which is inherently either different or more efficient, or just different from the existing channels that exist. I would say that's my number one, filter. Because I think if you can do that, then you can sort of gradually, I do believe that on the back, I'm happy to underwrite that, you can build the technology, you can build the product, you can even do the warehouse and things like that, because I feel they're more like a function of capital again. And once you have the demand, you can figure some of those out. But competing for demand is really, really hard. And that really kills companies. I think that for me, that's number one.
So how do you think companies or founders should go about identifying their GTM? Like, is there any sort of playbook you've identified over the years, having invested in multiple companies? And what is the one thing that founders did right when it comes to identifying their GTM that most others did not?
So I think GTM is really, and this is very deeply linked with that PMF and 0 to 1 problem,
right.
So I think this is, again, goes back to the kind of the crux of entrepreneurship, of this nature, how you build businesses, how you overcome that 0 to 1 problem. So unfortunately, this is one where lesser, I think, a formula is may not. This is where the true entrepreneurial rigor comes in.
Right.
The only way I found is just deep experimentation, trying different things and then latching on to stuff that is breaking out, or deep domain experience, in certain things, and sort of building around that. So I don't think I have like any sort of real tips I can give you on this other than just experimentation.
So what would one way to sort of summarize it be to say that you just get enough number of early adopters on board, and these adopters are recurring users of your platform? Would that be a good enough evidence that you've captured the market?
And how you got them, I suppose. Sure. Did you, for example, know these people? Did you call them, get them, right? How replicable that sort of formula is of getting these early adopters. So I think, but yeah, I think that would be.
But what would you, let's say, speak about, the model of companies like Zepto, where there's a rather high churn, and it's not even sort of, a behavior transformation business, like something in the space of alcohol, or not even something like a product where you cannot go back out of it, right? So today most of the e-commerce or such businesses would primarily are being used by people primarily because of the discounts offered. So the moment you sort of, let's say, reduce the discounts or increase the price of delivery and stuff like that, maybe customers are going to drop out. So how would you, let's say, evaluate PMF in such cases?
So I've never looked at Zepto specifically, myself, but I think my sense is that there was a whole slew of Zepto fell into that X for Y category,
right.
And there was a whole slew of instant delivery companies that got funded, in the last 2 years. So it was obviously Instacart in the US, and then actually there's a Philly company here, I forget the name, which got funded by SoftBank and got to 14-15 billion. And then there were companies funded in Europe and things like that. So I think there was, again, sort of an X for Y type of belief that instant delivery is a large market, driven by whatever sort of metrics people would have seen in some markets. And, obviously the GMV grew very, very rapidly, even though it was fueled by discounts. So I think I feel Zepto was a benefit. Like, for example, a company like Zepto, and again, I don't know anything about Zepto, would find it much harder to get funded in today's environment, where sort of capital is tighter and, people are looking at more fundamental business models and things like that. So I do think it was kind of a product of the market conditions and X for Y at that time.
Interesting. And one last question, Rajul, is if you just graduated in 2022, what would you be building today and how would you approach it?
So if I had, I think especially on the tech side, it's useful to catch trends and be in spaces which are growing. Even if you get it wrong, you can sort of figure out over a year or two, because you're so young. If I'm graduated this year, I have plenty of time ahead of me, so the cost of losing out a couple of years is really not that high, for somebody who's graduating today. So if I were doing that, I would sort of look at sort of blockchain and Web3 kind of stuff. I personally do believe that it's here to stay and it'll grow slowly. It might be a 10-year, 15-year journey. But if I hang in there, and take the time to understand the space, it does throw opportunities to, find places where I can build real value, disproportionate value, and things like that. So I would probably, if I were to put my macro hat, that's how I would sort of think about it. If I were to put my bottom up hat, then sort of whatever pays your bills and, gets you started is a good way to start. Yeah.
Interesting. And that's personally reassuring for me, since I'm building a decentralized solution. But yeah, it's an interesting space. So what about blockchain do you think? I mean, of course, we know the thesis around, decentralization and security and sort of P2P networks and all of those. But the one thing that really differentiates or let's say hinders people from really onboarding to the Web3 world is maybe in some sense a fiat on-ramp, or how do you really convert from your fiat currency to cryptocurrencies, and how do you incentivize participants of the decentralized network? And do you have any thoughts on what might be the reasonable approach to go ahead?
Obviously, over the last couple of years, when the capital was cheap, the solution was to throw money at it, right? I mean, deep discounting and sort of incentivize people to convert from fiat to crypto, get them. I mean, that's been the traditional venture approach, to everything, where sort of you see a big market and you want to convert people, so you throw money at it. I think in today's market, I would say approach would be to find some real use cases, which are compelling to users, and they find a real reason to do this. Like, for example, just before this call, I was on a call with a gaming company, which I felt was interesting. So if you sort of allowed people to buy game assets and things like that, which you really can't do, without the Web3
Right.
infrastructure and LPs and this and that. So I think finding compelling use cases which people find interesting, and using them to convert is probably the wise thing to do in today's market.
Interesting. And before we close, any advice for aspiring entrepreneurs today?
Just keep at it. I would say, I think in every day and age, I think persistence is golden. I mean, I know it's kind of cliched and it's tough, but the journey is long. I know we look around us and sometimes we see people, who got disproportionately successful from the outside in a short period of time, but that's very, very uncommon, and few and far between. I think most people sort of just grind their way to success over years. So I think that would be my advice. Just keep at it, keep close to the market, keep pivoting if you need to, but keep at it. Yeah.
Got it. Thanks a lot, Rajul, for doing this.